Hello, and welcome to the first episode of the officials from the new Flux Studio. We've got a busy week this week, having had some OSPs from ADNOC and Aramco, significant changes to the structure, both in Dubai, dated, and the futures. So we've got a lot to talk through. So let's get started first off with the Aramco OSPs that came out this morning. So guys, what do we think is the key thing to focus on in this OSP release?
Yeah, well, I mean, going into it, the market was pretty split, I think, in what participants were expecting. We saw ranges from $1.60 cut all the way down to no cut for the flagship Arab Light into Asia. And what actually came out, we had a cut of $1.20 for both light and extra light, as well as a cut of $1.40 for medium and heavy. And to me, that's kind of, it's a bit of a middle of the field kind of OSP from Aramco. We saw, according to structures, if you looked at the monthly averages, we're implying a cut of about $1.60. And as we'll discuss, when ADNOC released their OSPs, they were more in line with that. So this is kind of, to me, this is a bit of a firm OSP, actually. It speaks to almost, it sounds like good demand in Asia to me.
In a way, because as you say, we have the full breakdown of the OSPs by grade and by region, so destination region. And as you say, 120 cut for Arab Light and extra light, 140 for medium and heavy. And obviously the Dubai structure reduced on average in terms of physical premium by 160 month on month. So cutting it by 120 is, for Arab Light, is 40 cents less than the structure implied. Yeah. The final week average was a bit messy due to the expiry and the various window players going in and out, a bit of a kind of a chaotic final week of the window at the end of October. So I kind of agree with you that it's firmer than I think most were expecting. And in fact, we did a poll on our Twitter account yesterday to ask people in advance of the release what they were expecting. And we had the results here. I mean, the majority, well, there was no majority. It was a minority verdict in favor of $1.01 to $1.50 cut.
Yeah.
But it was pretty well spread between with the smaller cuts as well, the up to 50 cents and 51 cents to $1.
I mean, just look at that. No change to minus 50 cents was the second most popular. So it was really quite divergent.
Yeah, definitely. But you raise some interesting points here. But I think we also need to flag that the average Dubai parcels price over the previous month's trading was 5 cents lower month on month.
$5,
$5. Sorry. So the change from September trading to October trading average was over $5, and that's pretty cheap. That's pretty cheap. So considering the 120, it's slightly not as strong cut as some would have expected. But given the low oil prices and the fact that everybody's questioning whether we are still in a super glut. And what's the demand from China? Because we also have the story with China. India, we've heard from the market, they're already buying some Upper Zakum, Middle Eastern cargoes. But Russia is the interesting one, because is China going to absorb all of the Russian demand?
The key point that you raised there, I think, was flat price, right? China are flat price buyers. We know that when the price is below 70, price is right, and they tend to come in and buy. There was a lot of concern, I think, in the market that perhaps they've slowed their purchases. We've seen them flip sell side in the window, and also, according to sources, in the over-the-counter markets as well. So, I mean, that was raising a lot of concerns that perhaps the SPR purchases had slowed down. But, I mean, these OSPs into Asia, they're pretty firm. So, I mean, to me, that says, according to the Saudis at least, they're expecting the Chinese to be back buying.
Yeah, and I think obviously the next step in that process is the allocations, which would be pretty interesting, because we had a low month last month. We're down to the high 30 million barrels per day. 30 million barrels for the month. That was down from 51 million. So we were coming off quite a high point. And it is seasonally expected, I suppose, for November to be a bit lower due to maintenance and so forth. But that was a big drop month on month. Whether we'll see a bounce back, we've got a bit of a division between the team going on how many we're expecting. We have a little bet going on, but there's no consensus, and that will be a key indicator, I think, for the market as well, because we've seen today there's been a big sell-off as well in terms of both flat price and structure, which seems to be weakening across the board, really.
Yeah, definitely.
Yep, go ahead.
But also interesting in terms of the OSPs, it's that they didn't cut to other destinations. They didn't cut to Northwest Europe, for example. We've seen dated Brent remains very weak for majority of October trading. It was very weak. Physical differentials were negative. We saw a bit of a big steepening. We're going to discuss later in the chart, but as you flagged it as well, it's that seems like kind of a balance they're trying to do right now. But we'll see if there's a bit more firmer demand in Europe. But according to some export data we had seen recently over, I think, the previous month, it was really interesting that we saw exports to Europe were up year on year. So we need to see if that still continues, that trend still continues, and that appetite from Europe.
Yeah, and I think, like you say, the European, both the Northwest Europe and Med, they were held steady to the US Gulf. It was minus 50 cents, so a much smaller cut than it was to Asia. And I think that is largely down to the dated Dubai dynamic. But to move on to the ADNOC OSPs, which we got yesterday, we have that chart up here now as well. And the one to really look at is, I think, Upper Zakum, because you've got Murban is set at, the average of IFAB Murban futures settlement over the month. So that's entirely expected. 443 weaker though, month on month. Like, as it's expected because the settlements in advance. The key thing for the ADNOC numbers are the diffs, and Lulu and Das relatively are much firmer in terms of the monthly delta than Upper Zakum, which got a big cut, 70 cents versus Murban. So we're now down at a $1 discount to Murban for Upper Zakum.
Exactly. So on a Dubai basis, that's down $1.70. So that's a pretty big cut, and I think there's a number of different things going on here. We know that our race is running less Upper Zakum. According to Petrologistics, they didn't take any Upper Zakum for our race in October, the first time since 2023. We also know that there's potentially going to be some refinery outage there as well. So we've got more exports, and therefore it makes sense then needing to create that room in the market.
Yeah, I think the refining side is also important as well, because as you mentioned, our race obviously not taking as much or any Upper Zakum. That's kind of been a trend since early summer when we had the whole situation with the Murban export schedule being changed, last minute impact on cargoes being reduced and then increased again to the full amount. So that's one of the key factors. Also, we have refinery outages in India, unplanned, Kuwait as well. So we've seen a massive rally in gas oil cracks, and we haven't seen the consequential rally in medium sour Upper Zakum, which yields a lot of diesel, a lot of fuel oil. And I think that's been really confusing a lot of people.
Definitely.
And I think partly it comes down to the fact that maybe there just isn't enough capacity to absorb it,
the
given
demand
these
outlet
outages.
isn't there, and all of a sudden you have an excess of cargoes. It'll be interesting to see how long that lasts, how quickly they can get refinery capacity back online. But we have turnarounds in Europe as well. So, I mean, it makes sense that the market is fundamentally quite long right now.
Yeah. And in terms of Upper Zakum, again, in the window, so the spot window, we had a lot of convergences last month that were Upper Zakum. So, Spiros, do you know exactly like why, what that could tell you?
Yeah, definitely. I mean, it tells us that Upper Zakum is basically the cheapest grade, the most competitive grade in the window. Well, the last 2 months pretty much were very interesting. We saw in September trading, Upper Zakum was declared so many times that it was on a barrel per day basis, it was over 630,000 barrels per day. So that's about, if we were to, according to some of our sources, that's 50-60% of the Upper Zakum field production daily.
Yeah.
So it means, the demand was there, and Upper Zakum was the cheapest one, and it continues to be cheaper relative to Dubai. If we're going to see, if we're looking at the diff here, that's about minus 5.1. Dubai was around minus $5. So, 10 cents cheaper than Dubai. It seems, that's still going to be the cheaper grade along the way.
Yeah, and I think it's even worth noting that it weakened relatively again in October even further. Like we had a 10-cent discount looking at the average of the Dubai partials assessment versus the ADNOC OSP for Upper Zakum for November, and then for December it's a 20-cent discount to Dubai. So it is weakening even further. But talking about weakening, we had, as you mentioned, Spiros, a very weak period in the physical differential for dated Brent in October. It recovered significantly last week, but it looks like things are going the other way, and it's kind of gathering steam in terms of this overall structural decline. So what do we think is going on here?
I mean, recently you never know what's happening in the dated. We had so many quiet days in the window, and then we had a big rally. I remember the start of October, Vitol came, and they were started bidding a lot. That shifts our physical differential up to almost $1. That was a dramatic move. And then, it was another week of pretty much no activity, and people started offering. And then recently, over the last few days, the same trend happened again. So we need to see what's going on in the physical demand, at least in North Sea. CFDs are very weak right now. However, from memory, except including the BAL week, we also have week 1, week 2, week 3. They're all deep negative right now. So that means that prompt demand, expected demand over the next few weeks is gonna be decreasing. So it's interesting where we're gonna see where we're gonna see this to play.
Yeah, I think part of it does come down to the refinery situation again. Like, autumn tends to be this maintenance period, same as it is in China, where we saw the reduced allocations for November as a result of that. But the North Sea has been very choppy lately. Like you say, you had the period where it was a lot of bidding coming in, very little sell-side interest, and a quiet period, the opposite, and then another quiet period, and then lots of bidding, no real sell-side interest, and then it's completely flipped. The last couple of days, we've had loads of offers, very, very aggressively lowered, and nobody's coming in to lift them. So really, I think it's partly a window thing that it's being so choppy, partly due to the function of the window.
What do you see dated going from now, guys? I think, freight is very expensive right now, especially Midland. It's very, very expensive. So I wouldn't be surprised if we go again negative in the next few days.
Yeah, I think you need someone like a Vitol or a big player like that to step in and start lifting the cargoes, maybe begin bidding. But then there is the threat that we flush out a few cargoes, and then we have a buy side play that comes in and raises it even more. We have another aggressive move upwards. So that's a tricky one to call, I think.
Yeah, and soft in the North Sea.
Yeah, and then that softness also extends to the futures spread. So here we have the January-February Brent futures spread, and like since the sanctions, where you can see at the beginning of the chart there, end of October, you had that massive jump in terms of the spread when everyone was beginning to talk about contango threat. Like there were only a couple of spreads that were still backdated, had that jump on the EU and US sanction on Russia. And then since then, we've been kind of steadily declining, particularly through November. And today, even since we took the screenshot, we've weakened further down to like 22 cents on the prompt spread. So we are looking at a much weaker futures curve, and this is, I think, reflective of the weakness that we're seeing in the physical as well, in terms of both Dubai and dated Brent physical differentials and premiums both coming off. Is contango coming? Full-on contango, guys?
I mean, March and April right now, the futures are trading in parity. So we're zero there, and then April onwards, everything is in contango again. So it seems this super glad stock is, although we're not hearing about it, people are for some reason worried. Everybody is also questioning how much crude is stored in the sea. That's floating and not being transit. Although this number is falling week on week according to some ship trackers, it's still on an elevated number. But I don't see that this weakness that much that it would cause something like the prompt spread trading around 20-25 cents.
I think there's a range of factors again going on here. I think yes, demand is probably a little bit soft relative to supply, especially now that we've had Saudi producing a bit more than they were before, although the recent OSP setting seems to suggest they're probably not going to be bringing huge amounts online. So yeah, fundamentally, it looks like balances are probably a little bit long, but we've got refinery outage, so naturally that's going to soften crude spreads. But we also have very low product inventories, which is leading to pretty tasty margins for a lot of refiners. Like if you look at Onyx indicative refining margins in Asia and Europe, they're the highest they've been all year. And that naturally at some point will incentivize capacity coming online. We know in China, for example, there is a lot of spare capacity that can be tapped. And they've definitely been buying enough crude for it. So that's one area that could come back online and resurrect a little bit of strength in the physical crude market. It's very hard to gauge at the moment what demand is looking like, I think. Demand, one, we're starved of data from the US with the longest shutdown that's ever happened
in history,
but two, also those kind of key regions like China, it's very difficult to tell. We're seeing a lot of diverging signals on the macro side.
But when it comes to the product stocks as well, you mentioned they're low. And I think it's worth mentioning as well that in the US, particularly distillate stocks, given the EIA data yesterday, I added them up, and since kind of mid-late September, they've drawn more than 13 million barrels from distillate stocks. And gasoline stocks keep falling as well. We had a big build in crude, but that followed a big draw last week. So the crude seems to be going up and down a bit. It's a bit wobbly. That, I think, largely depends on the imports. So last week, for instance, we had a big drop in imports, consequential big drop in inventories. But the products do seem to be going one way only, and that is down, both for gasoline and distillates.
And of course, time spread structure is a function of supply, demand, and inventories. And if we're drawing on products and products are low, then for me it's going to be tough to drift into a futures curve contango for an extended period of
particularly time. With such strong margins. I mean, December EBOB margins are incredibly strong, and unseasonally so. So,
I mean, and we know turnarounds are happening at the moment. They should unwind within the next quarter, and then come first quarter of next year, I think we'll be trading in a much healthier looking.
Yeah, definitely. Market. Especially the distillates, the middle of the barrel. Gasoil roofed this morning over $32 per barrel, and it's really interesting to also flag Russia is a big exporter of diesel, and they put this export ban in September from memory only to refineries that are not producers as well.
So for example, Rosneft can operate a refinery and export its diesel. But an independent can't buy oil, process it, and then export diesel. Exactly. It would have to be an integrated major.
But I saw some interesting data in October, for example. Russia, also the Kuwait refinery played a big role. The exports from diesel exports are very down on seasonal levels, but also on the year. We're talking something, from memory, I think around 10% lower. So gasoil stocks are significantly low everywhere, all over the world. So that needs to come back up at some point, and that implies obviously some medium sour or heavier crude strength that we could see onwards. Especially, in my opinion, in Dubai, we had the physical premium around 95-96 cents this morning. That's pretty weak.
That's weak. That's the weakest we've seen for a while. Really. So I think frankly there is a case to be made for this being the kind of the bottoming out of the crude structure, and that we're going to see a bit more backwardation. But that's one to see really, I think, with the refining situation and with the inventories situation, particularly for products. So anything else that you think we need to touch on, guys, or is that basically a good rundown of the last week or two in the markets?
That's pretty good from my side.
Okay. Well, very good then. Thank you for watching, and see you in the next episode of The Officials.